Hey, Jim Kennedy here with Kennedy Mortgage in Texas, Austin, Texas specifically. I wanted to talk to you today, present a little video here today about DSCR loans and how they work, debt service coverage ratio loans. These are great for investors, property investors, not for people that want to buy a home or whatever as their primary residence, but these are specifically for property investors. So let's dig into it and we'll see what we can come up with here. What is a DSCR loan? Qualifies based on the property's cash flow. DSCR, debt service coverage ratio, is your gross monthly payment, your gross monthly rent payment divided by your monthly principal, interest, taxes, and insurance and HOA dues. No W-2s, no tax returns, no personal income verification required. Lenders qualify the property's rental income against the monthly mortgage payment. So, as long as a monthly mortgage payment is above the if the rent payment is $2,000 and if the mortgage payment with the principal, interest, taxes, and insurance and HOA dues is $2,000 a month, and you're at 1.0, debt service coverage ratio is where most lenders need to be. So, above DSCR above 1.0, basically the property cash flows, and below that, say 0.75, we can't, it can still happen, but you want to be typically at that debt service coverage ratio of 1.0. The debt service coverage ratio loan is designed for real estate investors only, not for primary home buyers, like I said before. The ideal borrower profile: what kind of borrower is a DSCR loan good for? Real estate investors, like I said, that own multiple properties, self-employed borrowers, investors who want to close an LLC, anyone buying a short-term rental, Airbnb, vacation rental by owner, that sort of property also. Investors who want to scale fast without DTI, debt to income ratio limits, and first-time investors with strong credit. So those are really the great fit for the DSCR loan. Not a fit, primary, like I said, primary home buyers that want to buy a home for themselves to live in, not investment property. That doesn't work. So properties with no rental income potential, borrowers with a credit score that are below 620. Like I said, ideally you want to be somewhere in the 720 or above to get the best loan to value of 85%, 15% down. So first time home buyers not eligible. You need to at least you need to have some kind of a rental history of some sort, or at least have a primary residence at least to start with. Qualifying guidelines: credit, LTV, and what it takes. Like I said earlier, you need to have a 620 score. Ideally, you want a 720. That'll get you up to the 85% loan to value for a purchase and a rate and term refinance. Cash out refinances, you can go up to 80% loan to value. And if you're underneath that 1.0 debt service coverage ratio, the DSCR ratio, the most you can probably get on a purchase is 75%. Also reserves, which is your principal, interest, taxes, and insurance and HOA fees. They generally want a 6-month reserve requirement. Have that in a bank account in case something doesn't work out, or you have problems, with getting a renter to make the payment. So it's more of a cushion for the underwriting guidelines and for the lender. So in finance properties, you can have unlimited properties. On a conventional loan, the most rental properties you can have is 10. On a DSCR side, you can have unlimited properties. You can have 20, 30, 40 or more. So, but each lender only will allow, each lender will only finance up to 10 properties per LLC or per borrower. Loan amounts and terms: more flexibility. The minimum loan amount is $100,000, and we can go up to $3.5 million or even $4 million in some circumstances. There's 15-year term, 30-year term, 40-year term, interest-only terms available. Gift funds allowed. Like I said earlier, no limited on finance properties. You can close in an LLC. Business purpose lending available. Seller concessions up to 6%. Yeah, to reiterate on the interest-only option, the lower payment obviously gives you a better DSCR ratio. Pay interest only for the first 10 years of the loan. Lower monthly payment means lower principal, interest, taxes, and insurance, so that a lot of times then you can fit underneath that debt service coverage ratio of 1.0. Lower principal, interest, taxes, and insurance equals higher debt service, the coverage ratio. More deals qualify that way. Qualification based on the interest-only payment. So oftentimes, if you're struggling to get to that 1.0, the interest-only payment, will get you over the top. So that's something that's always nice to have. in case the actual ratios themselves are pretty tight. What kind of properties qualify? One unit single family homes, duplexes, triplexes, quads, 2 to 4 unit properties, warrantable and non-warrantable condos, short-term rentals, the Airbnbs, the vacation by rental, VRBOs. I actually did a couple weeks ago a manufactured home of all things. Generally those are limited to a VA or an FHA or conventional, where it's a owner occupied primary residence. I was able to get this done, but at a 65% loan to value. However, it did work. So keep that in mind. Like I said, 1 to 2 unit, 3 unit, 4 unit, warrantable, non-warrantable condos, and even so. Yeah, I mean, you can finance Airbnb with a DSCR loan. Purchase, rate, term, cash out, refinances, all available. Minimum 1.0 DSCR. So, like I said, your payment has to at least equal your rent. Actually, the rent that you take in has to equal the principal, interest, taxes, and insurance and HOA. Um, Air DNA rentalizer report accepted for new purchases. Lender applies a 20-25% haircut on the projected short-term rental income per their guidelines, just for more of a cushion on their end. 12 to 24 month platform history for use for existing short-term rentals. LLC vesting allowed, like I mentioned earlier. Purchases on a 720 credit score on a short-term rental, you can go up to 80% loan to value. Purchase with a 700 score, we're closer to 75% loan to value. Refinance max 70% LTV on a short-term rental. Must verify local short-term rental permits and HOA approvals. City or HOA short-term rental ban. Deal goes to long-term rental guidelines instead of short-term rental guidelines. So why do investors choose DSCR loans? I mean, it's for the ease. I mean, there's no tax returns, no W-2s, no personal income to report, no personal debt-to-income ratio calculation, unlimited finance properties. You can close in an LLC or corporation. Gift funds are allowed. There's 15, 30-year, 40-year interest-only terms available. Like I said, interest only available. Short-term rental income accepted. And a conventional loan on the other side, it's full income docs, tax returns, W-2s, pay stubs, sometimes bank statements. We can use those. Personal DTIs do apply at that case. The most you can have is 10 rental properties. Must close in a personal name. Strict gift fund rules, 30-year fixed standard only, usually not a 15 or a 30 or a interest only. Well, you usually do 30-year or 15-year, 40-year, and interest only are usually hard to come by in the conventional side. So no interest only option. Short-term rental income rarely accepted for new purchases. So you really need to be in the debt service coverage ratio side of the loans that are available out there to do short-term rental properties. So how fast can you close a loan? Some of the documentations you need your credit report, asset verification, your bank statements for your 6 months reserves and your down payment, lease agreement, or Air DNA rental report, a 1007 reform that the appraisal provides with the actual appraisal itself, the purchase agreement, short-term rental permits, HOA approvals, those kind of things we need to have. Obviously, typical timeline, you can get you approved in 1 day or less. Underwriting, appraisal order in 1 to 2 or 3 business days. Appraisal, you usually get that back in 1 to 2 weeks. Underwriting 1 to 2 weeks. Clear to close 30 days, typically on a debt service coverage ratio loan. Much faster than conventional. No income review delays, that sort of thing. It frees up and makes things a lot easier to deal with. Yeah, so in summary, DSCR loans or debt service coverage ratio loans are fantastic for property investors. No personal income needed, no W-2s, no pay stubs, no tax returns. You need a 620 minimum, but ideally a 720 to get that 85% loan to value or 15% down. So loan amounts up to $3.5 million, but a minimum of 100,000. 15-year, 30-year, 40-year interest only terms available. Short-term rental eligible. You can close in an LLC. Eligible properties, single-family homes, duplexes, triplex, quads, condos, non-warrantable condos, and in some cases manufactured homes also. So at any rate, I hope this information was useful. And if you have any questions, reach out to me. Once again, Jim Kennedy here, Kennedy Mortgage. I'm out in Austin, Texas, 512-553-2111. Like I said, please reach out if you have questions. And I hope this was useful. Thank you so much.